Hello everyone, welcome back to my channel. So this video is a video that I wanted to do for already a few weeks now, and I think that finally the time has come because we are in mid-January and the earnings season is fast approaching, and because of that I think now we'll be able to show you how can we profit from upcoming earnings releases using options. Basically, I'm going to show you a strategy that you can use. Also, of course, if you have already a position in a given stock, and so you can use that position along with this strategy, so that then you can not only hedge your position against a potential large downswing, which of course will hurt your holdings, but also you can profit from it in case the stock shoots up after a favorable earnings release. And so even though of course you would profit anyway as long as you keep the holdings of the stock, but either way, this is something that will magnify your earnings on one hand, or it will protect you from any downside, and in the same vein it will allow you to profit if for some reason the stock goes down as a result of earnings. And so the strategy in this case is the double calendar spread, and we will assume in this example that I'm going to show you, and we will use Tesla, the technological company, which is also quoted on the Nasdaq and on the S&P 500. And as you can see online, Tesla is due to release its earnings on the upcoming January 29th, which will fall on a Wednesday. Today, as I'm recording this video, this is January 12th, this is a Sunday, and so this example will use data which was applicable at market close on the previous Friday, which is January the 10th. And so in this particular strategy, the double calendar spread, we'll use two different types of options which will expire just before the earnings release, the previous date, which will in this case, as you can see right here, since the earnings will be on the 29th, the previous maturity date for options will be the January 24th, and then another set of options will be the ones expiring on January 31st, right after the earnings release. And one of the main features of this strategy, and this is basically seeks to profit from the differences in implied volatility of the two maturities, as well as from the continuous loss in time value until we close the trade. And I can show you, for example, here I've already opened option chain here on Tesla. And as you can see here, this is the option chain for the coming week, which will end on January 17th, Friday. And as you can see right here, the implied volatility across this option chain is 55.2, right, which is a little bit further down than the current historical volatility and the implied volatility of the stock, of the options on this stock overall. And as you can also see that the next week, so the following week, which will be the ones we will be using some options on, which is the week ending on the January 24th, so just before earnings release, you'll see that this implied volatility will also remain very close to the previous one, so it will even go down a bit to 53.3. But once we get past the earnings, and the options which will expire on January 31st have already a much increased implied volatility, in this case 69.2, which already exceeds both historical and implied volatility of Tesla. And then as we move forward, you will see that it will continue to be elevated in this case for the options 4 weeks from now, it will gradually die down. So it will be 66.4, and then it will be 62.6, and 61.7, 60.6. So it will gradually die down, the implied volatility, but this stark difference between the volatility of the ones expiring just before earnings here and the ones expiring just after the earnings are released, this big differential, which is approximately 16 percentage points, this is something that we will use to our advantage as we move to our with our trades. So as I was mentioning, we will try to profit from the differences in implied volatility of the two maturities. And so let's just assume that in this example we have 100 shares of Tesla, so we will use one contract of each leg of this strategy, because each option contract is relative to 100 shares. And so this double calendar spread will be comprising of a short strangle, which will expire just before the earnings date, all right, which is the January 24th, as we saw here. And then we're going to use a long strangle expiring just after the earnings release, meaning on January 31st. I'm going to show you here, for example, because I put in some graphs over here. So this is a short strangle. This is a strategy we're going to pursue just before the earnings release, all right? And this is the strategy we will use, which will mature just after the earnings release. And so because this volatility is expected to be relatively lower before the earnings, we'll expect that this particular strategy will allow us to maintain within these bounds here, which is the two strike prices that we elected, the 380 and the 405. And then once the volatility increases, we will also be in a relatively good position, because if we have a large swing on a stock, either up or down, we will be able to profit from the trade either by selling these options, or simply waiting until they mature and we exercise, and we, in case of going very much down, we will be able to exercise the put and sell it and sell the stock at 380, or if it shoots up, we will be able to buy it at, and we hope so, a much lower price, in this case 405. All right, and so moving on from here, I just show you here, this is a screenshot that I took today, as you can see right here by the date. This is January 12th, and I'm going to emulate this particular setup, which is right here. So sell two options expiring on January 24th, put in a call with the strike price 380 and 405, and bought also stocks with the same strike price but expiring on the January 31st. All right, and as I mentioned here, I'm going to zoom out a little bit. As we saw, the implied volatility is higher after earnings, and because of course once the earnings are released, large price moves are more likely, and so the implied volatility is higher for the long strangle relative to the short strangle. And because of that, the long strangle premiums are of course higher than the ones that we will use for the short strangle, we will receive for the short strangle. And so we will have a net cost in this particular trade, and as you can see here, it will be $19.50, which multiplied by 100 will be $1,950, and I have the exact calculations right here, but I'm going to also show you on the interface of Interactive Brokers to see how this plays out. So this is, as I mentioned, the option chain of Tesla, and we are selecting the option chain for the options expiring on January 24th, so just before earnings. And so we are going to sell some options. I'm going to sell a put and a call. And why did I choose the 380 strike and the 405 strike? Basically because the stock was trading at 393.10, and we also are able to have a more or less of between a 12-13 point distance between these strikes. Of course, we can use, for example, a lower range, but I believe that this range is good as any other. And so we can use, for example, let's just see, we can use, for example, the 400 and the 302.5 because, or the 385, because we have more or less of a 7-point range between those. For example, we can use that, but in this example I just use a longer range, which will also allow us to have a slightly lower outflow of cash, initial outflow. And so yeah, basically that's the reason. And so we're going to sell a put with a strike price of 380, all right, expiring on January 24th, and we're going to sell a call with a strike of 405, which is right here. And now at this point we would receive a credit of $2,285. Now we are going to move to the option chain for the options expiring on the January 31st. We also are lacking some data for some reason, and that's all the more reason for us to use the 3080 strike price and the 405 strike price as well. And so we are in for this option chain, we are going to buy this put right here, and we are going to buy this call right over here on the 405 strike price. And so as you can see here, we were able to make this setup of the options. We will have to pay as a net cost 1,950 euros, which matches the value we have over here and also in the screenshot that I took earlier. All right, and so now with this setup, and given the fact that we are expecting that as we move towards the expiration date of this particular set of options, the price will move. And of course what's probably is going to happen is that there's going to be an increase, a gradual increase in some volatility, because we are getting close to the earnings date, and investors will be probably making some moves to protect themselves with some puts in case the stock falls down, and may also be, if they are confident, also buying some calls in case the price shoots up. But in this case, the most relevant trade should be more investors buying puts, which will build up the premiums of the puts. But so far at this point, this is all. We're going to have to wait, and again this is the setup, and now we are going to have to wait until January 24th to see what happens. Now at January 24th, what we are going to do is basically see if it's profitable for us to close the trade. And so what that means is that we will buy back these options, all right, because we assume that these options will no longer be valuable, and so it will be much easier, it will be much less costly for us to buy back, and we keep the differential between the premiums. And assuming that the price moved one way or another, either one of these calls will have a larger appreciation in price. If the price falls down, the put will build up in premium. If the price goes up significantly, the long call will build up in premium, and so we'll be able to sell those and compensate for this initial outlay, and still pocket a profit out of it. And so the plan, or the main plan, is basically to offset all of these positions just before the market close on January 24th and see if it's profitable or not, because if it's not profitable, we'll then wait until the earnings release and see if then we can, because of course by that time these options will already have expired, but we still have these ones, and by doing that we will be able to see if either of these options will become very valuable, so that then we can make up for this initial cost and still have a profit on top of that. And you can also see this as basically we did this short strangle to offset the initial cost of this strategy, because otherwise this strategy will be just this long strangle will be about $4,000, and so by using this short strangle we basically cut in half the cost. But we'll wait until January 24th and see what happens. And now it's time for us to wait and check how the market will develop in the next coming days, and then see what happens. So I'll catch you there on January 24th. Hello everyone, welcome back to my channel. So this is the second part of the video in which we are trying to show how can we profit with options when we have an earnings pending earnings release in the next few days or in the next few weeks. And so this is the second part of the video. I showed already in the previous part of this video which were the trades that we've put in. Basically we use a short strangle expiring the week before the earnings were released, and we also bought, so we entered into a long strangle with the expiration date a few days after, or 2 days after the earnings release. And so let's just see what the outcomes were. And so this is data. This video, by the way, is being recorded on January 26th, so it's on Sunday. So the market data available is the data from the market close on Friday, right, on January 24th, which is the day the short strangle expired. And so let's see the results and the way we see it. And this is something that this is a print that I took yesterday, Saturday, still with Friday data, but we will show what basically happened. So our short strangle expired, all right. The stock went up from $393.10 on the close at the end of the day on January 10th, and it finished this week with a much increased price, so 405.47, and so this is exactly what happened. And now we will see which are the current prices of or the premiums of the long strangle that we had if we want to close this position. And so this is exactly the premium of the call that we bought previously. So now to sell it we have to short it, so we have to sell it to offset the position. So we will receive this value 19.75, which multiplied by 100 is $1,975. And also to close the put leg of our long strangle we have to sell a put with the same strike price, which is 380, and we will receive 7.60 multiplied by 100, which is $760. And so this is exactly what you can see here in this picture. All right, so these are the same strike prices here, as you can see. And now let's see basically what happened, because we are using market close data, and so we decided to let our short strangle expire and see what would happen Now we can conclude that because the price closed above the strike of our short call, our shares were assigned, so we sold the shares at 405, so we had a minor loss of $47 because of these 47 cents of that the stock price went above the strike, and our short put expired worthless, and so nothing happens. We pocket this premium, so nothing to be done. And why did I put a loss here? Because if we happen to want to buy the shares back, we sold them at 405, but we had to buy them back at 405.47, so we would have a loss of $47. Now, because we want to basically reverse our short strangle, so because we want to get out of the long strangle, we have to make the reverse trade, and so we have to sell a put and sell a call, and so these are the prices or the premiums that we receive. All right, as you can see, it matches what is here on the screen, so the 760 for the put and 19.75 for the call. Right, and so here we are, the premiums that we will receive. And so now if we make the calculation, and keep in mind these were the premiums that we initially received, these ones were the premiums that we initially received for the short put, all right, for the short strangle, and these are the premiums that we paid initially to put together the long strangle. Now if you see the results, this short put expired worthless because this was the expiration date, January 24th, and we received initially this premium for this short call, but we have a loss of $47, so we have to subtract it, and still we keep this gain for ourselves, $1,183. Now for the long strangle, we initially bought this long put. We bought this put by 1880, and we received now to reverse this position $760, and so we have a loss here on this leg of the long strangle. And to offset this long call position, because we paid for this long call position this premium, 2255, we now receive, because we have to short this call, 1975, which gives us a loss of $280. And so if we calculate the profit of this gives us a profit of $735. Now keep in mind we are using only one contract, so the profit will be multiplied by how many contracts you have, depend on the size of your account. And so if we consider that we spent 2 weeks from January the 12th to January 24th, from January the 10th to January 24th, so this is 2 weeks, this gives us a profit of 37% over the course of these 2 weeks. And if we annualize this profit, and because it was 2 weeks, there are 26 periods of 2 weeks in a year, and so the result would be 980%, give or take. Keep in mind that we are not accounting for commissions and fees, all right, and of course slippage in terms of the bid-ask spreads, but in general this would be the profit that we would accrue in this situation by using the the double calendar spread on the Tesla shares, with the upcoming earnings released on the 29th, I believe, on the 29th of January. Let me see if I got it right. I think it is. Let me see. Yes, on the January 29th, Tesla will release its earnings. All right, and so basically this was a quite profitable trade. Now, why this has happened? Basically, what happened was that the Tesla stock, as we mentioned before, rose from $393.10 to $405.47, and so in the context of our short strangle, any implied volatility changes are not that relevant because we simply the short strangle expires before the earnings, so there are no significant changes in the position in these options, and because we are letting them expire and they expire before the earnings, the differences in implied volatility on the and the reflection of changes in implied volatility on the premiums is not relevant, because eventually their value goes down to zero. The time value goes down to zero, and so this is exactly what happened with our short put. The time value went out to zero, but because the price rose, this put went further out of the money and simply expired without any value, and we pocket the premium. Now, in terms of the short call, the time value of course went down to zero because the option expired. We let it expire basically, but the price rose and eventually crossed or broke through our strike price, so it went slightly to ITM in the money, and that's why the call was exercised, and we were forced to sell our 100 shares of Tesla. Now, the more interesting case is in terms of our long strangle, because in here any volatility changes will be relevant because we are in a holding options that will expire after earnings, and so a lot of trading and a lot of volatility is expected once the earnings are released, and at that particular time these options will still be live. And so because of that, if we look at our long put position, even though of course it lost time value because we are now closer to maturity closer to maturity than before. We are in this case 1 week before maturity, and it also lost intrinsic value because the price rose, so it went further away from the strike price, and so because it was deeper out of the money, basically it lost value, and that's why we ended up having a larger loss by closing out this particular position. Now, when it comes to the call position, to the long position on the call, of course, again, it lost time value, but it gained also some intrinsic value because it became in the money. The price exceeded the strike of the call, and so now if the market would close and we would enter the call entered or got into its maturity date, let's assume that it would be January 24th, it would make sense for us to exercise because we will be able to buy the stock at a lower price than the market price. So the option is in the money, even though we had a small loss because apparently the loss in time value more than offset the gain in terms of intrinsic value. But even so, this loss was relatively smaller, and so the combined result was still a very, very healthy profit. And so basically that's exactly what happened. This is a trade which has a very, very good probability of being successful, because basically what you are doing, and if we come back here, basically you are protecting yourself against large moves in volatility, all right? And because you are using a short strangle expiring before the expiration or before the earnings release, basically the purpose of this short strangle is to reduce as much as possible the cost of this long strangle, because long strangles are expensive because you are essentially buying two options, and the closer the strike of these options are to the current stock price, the more expensive they get. And so basically you are trying to reduce the cost of these two options by basically selling a short strangle and then pocketing premiums also from two options, both the call and the put. And yeah, that is it. Feel free to leave your comments below, any questions, any doubts that may have been raised over the course of this first part and second part. I'm also available on LinkedIn in case you have any questions. And also feel free to like the video and subscribe to the channel. I still have in mind making a video about the loss in terms of time value for both calls and puts. That is still on my mind, as I promised previously, and I will do it and I will post that video in due course. For now, yeah, I'll see you all in the next one.